Hey contrarians, Lumi Hashley here, representing the Decoding crypto team. Now, if you've ever felt like crypto is this chaotic, uncharted wilderness, you're not alone. But don't worry, we've got you covered. Think of this space as a vast digital frontier. And to navigate it, we've divided it into 3 distinct zones: Bitcoin, altcoins, and stablecoins. First up, Bitcoin, the OG, the one that started it all. Once upon a time, people thought it would replace everyday cash, buying your morning coffee with Bitcoin. But fast forward to today, and it's taken on a whole new role: digital gold. It's scarce, it's secure, and people see it as a store of value. No surprise that big players are scooping it up like treasure. Then we've got the wild, experimental world of altcoins. Think of these like startup ventures, projects with bold ideas, ambitious tech, and a whole lot of potential. But not all of them will make it. That's why, when you're exploring altcoins, it's all about the research. Who's behind the project? Do they have solid investors and partners? Is the tech even functional, or is it all hype? Vet them like you're a venture capitalist, because in a way you are. And if it sounds too good to be true, well, you know the drill. Lastly, the stablecoins, the steady ones in the crypto sea. Unlike the roller coaster prices of Bitcoin and altcoins, these guys stay anchored. They're pegged to traditional currencies like the US dollar, making them super practical for quick transactions or holding funds without the usual crypto volatility. Tether, USD Coin. These are the reliable names you'll often see in the space. That's the lay of the land, contrarians. 3 zones, 3 different vibes, and remember, the key to making smart moves in crypto: curiosity and caution. Always do your own research, challenge what you hear, and never stop learning. This is not a financial advice. If you're vibing with this breakdown, hit that subscribe button, give this video a like, and let's keep decoding crypto together. Now that we've set the stage, it's time to dive into the first zone: Bitcoin, the OG, the pioneer that flipped the script on how we think about money. And no, it's not just some internet experiment for tech geeks. It's a digital asset with a market cap that's climbed into the hundreds of billions, capturing the attention of rebellious investors, big financial institutions, and even governments. Let's rewind to where it all started. In 2008, the world was still reeling from a devastating financial crash. Trust in banks, rock bottom. That's when a mysterious figure, or maybe a group, known as Satoshi Nakamoto, stepped onto the scene. Nakamoto published a white paper titled Bitcoin, a peer-to-peer electronic cash system. It was a radical concept, a currency with no central authority. No intermediaries, just people directly transacting with one another through a secure, decentralized network. And then, in January 2009, the first Bitcoin block was mined, marking the birth of the blockchain. Shortly after, Nakamoto sent 10 Bitcoins to a programmer named Hal Finney, making history with the first ever Bitcoin transaction. Back then, people were skeptical. Digital money? Without banks? Sounds like something out of a sci-fi movie. But that's what made it revolutionary. Bitcoin wasn't built to fit into the existing financial system. It was designed to break free from it. Imagine money that no government could manipulate or print at will. No bureaucratic red tape, just a ledger that anyone could verify, but no single entity could control. Pure financial autonomy. Now, Bitcoin's initial pitch was to be an alternative to cash. Buy your coffee, pay for groceries, all with Bitcoin. But it didn't exactly work out that way. You see, Bitcoin is limited to 21 million coins, no exceptions. This built-in scarcity makes it more like digital gold than digital cash. And as more people started to see its value, the price skyrocketed. Suddenly, it wasn't about spending Bitcoin on a burger. It was about holding on to it like a precious asset. That's how Bitcoin evolved into what it is today: a store of value, a hedge against inflation, something people cling to when the economy gets shaky. And trust me, contrarians, economies get shaky. Take a look around. Central banks print money like it's going out of style, driving inflation through the roof. In times like these, Bitcoin becomes a lifeboat, because while fiat currencies lose value over time, Bitcoin's scarcity protects it. That's why some investors, especially those burned by financial crises, treat it as a safe haven. But with that security comes volatility. The price of Bitcoin swings like a pendulum, often driven more by emotion than logic. Fear and greed rule the markets. One day, Bitcoin is soaring to new heights. The next, a tweet or a regulatory announcement sends it plummeting. It's not for the faint of heart. Yet, through every crash and rally, one belief remains strong: Bitcoin's long-term potential. That's where the hodl culture was born. Picture this. It's 2013. Bitcoin's price is crashing and panic is everywhere. But one Bitcoin talk user, in a half-drunken fury, misspelled hold as hodl while ranting about his refusal to sell. The internet did what it does best, turned it into a meme. But beyond the laughter, the word took on a life of its own. Hodling is now a mindset. It's about believing in Bitcoin's future despite the volatility. No panic selling, no emotional decisions, just holding on, no matter how wild the ride gets. And while hodlers stand firm, Bitcoin continues to climb into mainstream acceptance. Even governments are paying attention. In 2025, the United States made a power move, establishing a strategic Bitcoin reserve. You heard that right. After seizing billions of dollars worth of Bitcoin from criminal activities, the government decided to hold on to it instead of selling. They see it as a hedge, a digital insurance policy, in case things go sideways in the global economy. But the US isn't the only player in this game. El Salvador, the ultimate Bitcoin trailblazer, made it legal tender in 2021 and started accumulating Bitcoin as a national reserve. Bhutan? They're not just buying Bitcoin. They're mining it using their vast hydroelectric power. Even economic heavyweights like Germany, Russia, and Poland are eyeing Bitcoin's role in their financial strategies. Whether they like it or not, Bitcoin is becoming a key piece of the global financial puzzle. Of course, it's not all sunshine and blockchain rainbows. Critics are quick to point out Bitcoin's energy consumption. The mining process, which uses a proof-of-work mechanism, requires enormous amounts of electricity. This has sparked debates about its environmental impact. But here's the thing. Innovation is constantly evolving. Renewable energy sources are being used in mining operations, and second-layer solutions like the Lightning Network are making Bitcoin transactions faster and more energy efficient. And then there's the regulatory tug-of-war. Governments are figuring out how to manage this unstoppable force without stifling innovation. Some countries embrace it, others crack down. But one thing's for sure, banning Bitcoin completely is easier said than done. This decentralized nature, Bitcoin doesn't rely on any single entity to survive. It's like a digital hydra. Cut off one head and two more grow back. So, contrarians, what's the takeaway here? Bitcoin is no longer just a fringe concept for internet rebels. It's a legitimate financial asset that's challenging the old guard. Whether you see it as a hedge, an investment, or a technological breakthrough, understanding Bitcoin means understanding how money is evolving. And if you're serious about navigating this world of digital finance, knowing Bitcoin's story is non-negotiable. But we're not done yet. Bitcoin may be the big boss of crypto, but it's just one part of the story. Next up, we're stepping into the unpredictable world of altcoins, the startups of the crypto world. And trust me, that's where things get even more interesting. Stay with me, contrarians. You won't want to miss this. All right, contrarians, now that we've navigated the world of Bitcoin, it's time to step into the next zone, altcoins. Here at the Decoding Crypto team, we like to think of altcoins as the startups of the crypto universe. They're bold, innovative, and brimming with potential. But just like in the startup world, not every project makes it. Some become game changers, while others crash and burn. The key? Knowing how to separate the visionaries from the vaporware. Altcoins are basically any cryptocurrency that isn't Bitcoin. While Bitcoin laid the foundation, these alternative coins emerged to tackle challenges Bitcoin didn't fully solve. Some aim to speed up transactions or lower fees. Others bring in entirely new use cases, from smart contracts and DeFi to NFTs and interoperability. With thousands of altcoins floating around, the innovation is insane. But so is the risk. Think of it like this. Investing in altcoins is like backing a tech startup. The potential for wild returns? Oh, absolutely. But the chance of losing your shirt? Also very real. A huge portion of these projects simply won't make it. That's why we never invest based on hype alone. We do our homework. And if you're here, that means you're ready to learn how to do the same. So how do we at Decoding Crypto evaluate altcoins? First things first, understand the problem. What is this project even trying to solve? A good altcoin isn't just another token. It has a mission. Ethereum brought smart contracts into the mainstream. Chainlink created a decentralized oracle system. Ripple reimagined cross-border payments. When a project has a clear and relevant purpose, that's a solid foundation. No purpose, no point. Then comes the product. This is where we separate talk from action. Is there something real? Is the tech live? Can you test it? Ethereum didn't just talk about smart contracts. It launched them. Polkadot didn't just theorize about blockchain interoperability, it made it happen. If the product's been in coming soon mode for years, that's a huge red flag. Promises are easy. Execution is everything. Now let's talk about the team. You want to know who's behind the curtain? Experienced founders with a history in tech or crypto? Big plus. Names like Vitalik Buterin or Charles Hoskinson? Huge credibility boost. But even anonymous teams can be solid, as long as there's transparency in other areas. At the very least, you want to see consistent development, clear communication, and a sense of accountability. But wait, we can't forget tokenomics. Yep, this is a big one. Contrarians. Tokenomics is basically how the coin works inside the ecosystem, how it's distributed, what the supply looks like, whether there's inflation or burn mechanisms, how rewards are structured, and whether there are any whales who could tank the project by dumping their stash. Understanding tokenomics takes a bit of a deep dive, but it's critical to figuring out whether a coin is sustainable or not. If you want us to break down tokenomics in detail, just let us know. We'll make a full video on it. Trust me, it's a rabbit hole worth exploring. All right, back on track. Next up, investors and partners. Who's backing the project? Who's building with them? Solid partnerships and respected investors can say a lot about a project's potential. Projects like Stellar and VeChain didn't rise to the top on their own. They had backing, and that helped them scale. And then there's the community. This one's massive. A vibrant, engaged community can literally make or break an altcoin. Just look at Dogecoin. What started as a joke became a movement. Same with Cardano. Its community is super involved, always pushing for updates and improvements. If people believe in the mission and are rallying around it, that's a powerful force. But contrarians, as always, watch for red flags. A lack of transparency, devs ghosting the community, no roadmap, or an endlessly shifting one, vague promises, or insane guaranteed returns. All of these scream, get out while you can. If it feels too good to be true, it probably is. Now, let's talk mindset. Altcoin investing isn't about finding the next 100x coin overnight. It's about thinking like a venture capitalist. You look at dozens of projects. You toss out the obvious scams, you study the promising ones, and you accept that not every pick will win. But the ones that do, they can change your life. Diversification helps too. Spreading your bets across solid projects with different strengths is how you play the long game. So contrarians, as we continue decoding crypto together, just remember, altcoins aren't lottery tickets. They're early-stage tech plays that require serious research, a calm mindset, and a strong BS detector. Get to know the purpose, the product, the team, the tokenomics, the community, and then decide if it's worth your time and capital. This isn't about FOMO, it's about being smart, strategic, and slightly savage in the best way. But hold up, don't go anywhere yet. We've tackled Bitcoin, we've dissected altcoins, and now we're heading into the final zone. Stablecoins, the digital dollars keeping the crypto world grounded. You ready? Let's roll. All right, contrarians, quick pause before we dive into the final zone. If you've made it this far and your brain's buzzing with crypto curiosity, you're exactly where you should be. And hey, if you're vibing with the way we're breaking this stuff down, simple, real, and no hype, now's the perfect time to hit that like button, smash subscribe, and turn on notifications so you don't miss a beat as we decode the rest of this wild world together. We're just getting warmed up. And trust me, what's coming next, stablecoins, might not be flashy, but they're low-key one of the most powerful tools in your crypto toolkit. Let's get into it. All right, contrarians, we've made it through Bitcoin, the OG, and explored the wild, startup-like world of altcoins. Now it's time to enter the third and final zone in our crypto journey, stablecoins. This is where things calm down. If Bitcoin is digital gold and altcoins are the experimental tech startups, stablecoins are the steady, dependable bridge between crypto and the real world. Here at the Decoding Crypto team, we like to think of stablecoins as the digital dollars of the blockchain world, not made to moon overnight, but to provide stability in a sea of volatility. So what exactly are stablecoins? At their core, they're cryptocurrencies designed to maintain a stable value, usually pegged to traditional assets like the US dollar. While the rest of the crypto market is bouncing all over the place, stablecoins stay grounded. That's why they're such a crucial part of this ecosystem. especially for investors looking to park their funds without pulling out of crypto altogether. Now, let's talk about how this magical stability actually works. Stablecoins operate through a system of minting and redeeming. When a user deposits collateral, either fiat like USD or another cryptocurrency, the protocol mints an equivalent amount of stablecoins. That's the minting part. Then, when a user wants to cash out, they can redeem those stablecoins and get back the original collateral. Smart contracts handle this entire process, making it automated, secure, and lightning fast. It's crypto efficiency at its finest. And here's where it gets even cooler. Stablecoins aren't locked in the crypto bubble. They integrate seamlessly with traditional finance, meaning you can use them to move money across borders, avoid bank fees, and make payments almost instantly. This gives them insane utility for real-world transactions, and it's one of the reasons they've become such a dominant force in crypto trading and DeFi. Let's break down the main types of stablecoins you'll encounter in the wild. First, we have fiat collateralized stablecoins. These are backed one by fiat currencies like the US dollar. Think of coins like Tether, USDT, and USD Coin, USDC. For every token in circulation, there's a dollar or equivalent asset sitting in a reserve somewhere. These stablecoins are the most widely used, offering high liquidity and reliability. But there's a trade-off. They rely on centralized entities to manage those reserves. That means trust becomes a big factor, and regular audits are key to keeping things transparent. Then there's the crypto-collateralized squad, stablecoins backed by other cryptocurrencies. This setup is more decentralized than fiat-backed ones, but it comes with its own flavor of risk. Since crypto assets are volatile, these stablecoins are usually over-collateralized. That means users deposit more than the value of the stablecoins they receive. For example, $150 worth of ETH to mint $100 worth of DAI. If the value of the collateral drops too far, liquidation mechanisms kick in to protect the system. It's brilliant, but definitely more complex under the hood. And finally, the most experimental of the bunch, algorithmic stablecoins. These don't use collateral at all. Instead, they rely on smart contracts and supply and demand algorithms to keep their value stable. Sounds slick, right? But it's risky territory. Projects like Terra, UST, have shown us how algorithmic stablecoins can unravel in dramatic fashion if the mechanisms fail. These coins represent bleeding-edge innovation. With potential, yes, but also with serious risk. So why do stablecoins matter so much in the crypto ecosystem? Simple. They provide a safety net. When the market is crashing, traders and investors often flee into stablecoins to protect their capital. They also make DeFi possible, acting as the fuel for lending platforms, borrowing protocols, and liquidity pools. Want to earn yield? You can lend out stablecoins and earn passive income without exposing yourself to the roller coaster ride of other assets. Stablecoins are also changing the game when it comes to payments and remittances. Sending money across borders traditionally involves high fees and long delays. With stablecoins, it's fast, cheap, and doesn't rely on banks. For people in countries with shaky currencies or banking systems, stablecoins offer a way to preserve value and gain financial freedom. And when it comes to trading, stablecoins are the unsung heroes. They're the go-to pairing for almost every crypto asset on exchanges, allowing traders to buy, sell, and store value without constantly jumping back into fiat. This boosts liquidity and smooths out the entire trading experience. So whether you're trading, farming yield, or just trying to survive a bear market, stablecoins are essential tools in your crypto arsenal. But remember, just because they're stable doesn't mean they're free from risk. Centralization, smart contract bugs, or collateral volatility. These are all factors you need to keep in mind when choosing a stablecoin to trust. As always, contrarians, the game is deeper than it seems. If you're curious about diving into the nitty-gritty of stablecoins, or how to use them in specific DeFi strategies, let us know. And if you want that deep dive we teased earlier into tokenomics, hit us up in the comments so we know to cook that up next. But before we wrap, contrarians, let's zoom in just a bit deeper. We've talked about how stablecoins bring calm to crypto chaos, but even within this so-called stable zone, there are big differences and big decisions to make. Not all stablecoins are created equal, and knowing which one to trust can make or break your strategy. Let's start with Tether, or USDT, the most widely used stablecoin on the planet. It's everywhere. It dominates trading pairs and offers lightning-fast liquidity. But with great popularity comes intense scrutiny. For years, questions have swirled around Tether's reserves. Are they really holding enough dollars to back every token in circulation? The lack of transparency has made some investors nervous, and while it hasn't collapsed, those question marks mean you've got to tread carefully. Then there's USD Coin, or USDC, the more buttoned-up stablecoin. Managed by Circle and backed by real dollars held in regulated financial institutions, USDC has built a rep for transparency, with regular audits and a more compliant posture. But even USDC had its moment of weakness. Remember March 2023? When Silicon Valley Bank went down, USDC briefly lost its peg. That event sent shockwaves through the market and reminded us all that even the most trusted stablecoins aren't invincible. Now let's flip the script with DI, a completely different beast. This one's decentralized, built on Ethereum, and backed by over-collateralized crypto assets. No central authority, no bank vault. Just smart contracts doing the work. That's awesome for financial freedom and censorship resistance. But the flip side, it's more complex, and its stability relies heavily on how well the collateral system is managed, especially when markets get shaky. The big takeaway? Stable doesn't mean safe by default. Whether it's questions about reserve transparency, algorithmic vulnerabilities, or regulatory crackdowns, every stablecoin carries some level of risk. It's crucial to understand what you're getting into. So how do you choose the right stablecoin? It starts with your goals. If you're looking for simplicity and widespread support, maybe USDC is your vibe. If you value decentralization above all else, DA could be your go-to. Need high liquidity for quick trades? Tether still rules that domain. But no matter which you pick, make sure you understand how the peg is maintained, what's backing the coin, and how much you trust the team or protocol behind it. And of course, practice smart security. Use trusted platforms, secure your private keys, and keep an eye on the latest news. Stablecoins might feel like the calm eye of the storm, but even in calm waters, it pays to stay alert. Now, we've explored Bitcoin as digital gold, altcoins as crypto startups, and stablecoins as the glue holding it all together. But before we wrap, let's pull all three zones together and talk about how to build your own strategy across them. Stick with me. We're almost there. All right, contrarians, we've explored the world of Bitcoin, decoded the chaos of altcoins, and chilled out with stablecoins. Now it's time to pull back the lens and look at the bigger picture. How these three zones fit together and what makes them so different. Welcome to the Crypto Showdown. Bitcoin versus altcoins versus stablecoins. Let's break it down, the decoding crypto way. Now here's where it all comes together. Market dynamics. Let's start with Bitcoin, the king, the blueprint. It was created as a form of digital cash, but over time it's become something bigger, a store of value. People buy Bitcoin not to buy coffee, but to protect and grow their wealth. It's like digital gold, rare, decentralized, and, in the long run, designed to hold or appreciate in value. When people say crypto, 9 times out of 10, they mean Bitcoin. It's the benchmark. Now, altcoins, that's the experimental playground. Every altcoin has a mission. Whether it's building a smart contract ecosystem like Ethereum, powering NFTs and DeFi, or solving niche problems like supply chain transparency or privacy-focused payments. Think of them like tech startups. Some will change the world, others will quietly disappear. But that's the thrill. For investors, altcoins are about finding the next big thing. And then there's stablecoins, the chill ones, the steady hands. Their job isn't to make you rich. It's to keep your value safe. One USDC or USDT is designed to always be worth around $1. That makes them perfect for making trades, sending money, parking profits, and just surviving the stormy seas of crypto volatility. They're the equivalent of cash in your digital wallet. But speaking of volatility, let's talk movement. Because these three play very different games. Bitcoin is volatile, no doubt. It's had boom-bust cycles that would make even the boldest investor sweat. 80% crashes, followed by insane rallies. Over time, though, its volatility has softened a bit, especially compared to the younger coins. But still, it moves, and it moves fast. Altcoins? Oh man. Welcome to the roller coaster. These coins can double overnight, and then lose 90% the next week. Microcap coins can swing wildly on a single tweet. Even the big boys like ETH and SOL can be shaky. But with that chaos comes opportunity. If you know what you're doing, stablecoins, if everything's working properly, they don't move. $1 in, $1 out. Any deviation gets corrected quickly. If they start drifting from that $1 mark, that's when alarms go off. Volatility here isn't normal. It's a red flag. So what about risk? Bitcoin is considered the least risky in crypto terms. It's the most battle-tested, the most decentralized, the most adopted. It's not going anywhere, but let's be real. This is still crypto. And that means regulatory threats and massive price swings are always on the table. Altcoins, though, high risk, high reward. You might 10x, you might lose it all. Bugs in the code, founder drama, lack of adoption, or regulatory crackdowns can crush a project. Some are legit, some are scams. That's why research isn't optional, Iodine. It's survival. Stablecoins are different. You don't buy them expecting growth. You buy them for utility and protection. But they're not risk-free. The big one is depegging. When that $1 price slips, maybe the collateral isn't solid. Maybe regulators crack down. Maybe there's a systemic issue in the protocol. If you're using stablecoins, you're trusting the mechanism or the company behind the coin. Now let's talk rewards. What's the upside? Bitcoin's upside is tied to long-term adoption. If more people see it as a store of value, even a global reserve, the price goes up, but don't expect another 1000x. Those days are long gone. BTC now is more like a long-term play. Slow, steady, foundational. Altcoins, that's where the real explosive growth potential lives. If you catch the right one at the right time. The next Ethereum, the next Solana, the next breakout layer 1 or DeFi giant, it's all in there. But it's risky. For every moonshot, there are hundreds of flops. It's startup investing in turbo mode. Stablecoins don't go up, but they work. You can earn interest on them in DeFi. You can transact easily. You can ride out market dips. Their reward isn't price, it's functionality. Let's get practical. How are these actually used? Bitcoin is often held as a long-term investment or moved in large amounts for international transfers or hedging against inflation. Some people use it for purchases, but that's not the primary draw. Altcoins are all about use case. ETH for gas fees, Link to connect smart contracts with real-world data, XRP for bank payments. You invest in altcoins if you believe in the mission and tech of a specific project. Stablecoins are the Swiss Army knife of crypto. You use them to avoid volatility, move between exchanges, earn DeFi yields, or even buy groceries in some places. They're digital cash. But here's something not enough people talk about. Your mindset has to shift depending on which of these you're holding. Bitcoin holders, you need diamond hands. You're in it for the long haul. You're stacking sats and tuning out the noise. That's the strategy. Altcoin investors, you're active, you're researching. You're staying up to date with development roadmaps, tech updates, team changes. It's like being a venture capitalist. You've got to be sharp, and yes, sometimes ruthless. Stablecoin users, you're about safety. Trusting the issuer, managing your wallets, maybe earning a bit of yield on the side. You're not chasing green candles, you're managing risk, and that's just as powerful. Now here's where it all comes together. Market dynamics. In bull markets, money often flows into Bitcoin first. It's the gateway. Then, as prices rise, investors may rotate profits into altcoins, chasing those bigger gains. That's when altcoin season kicks off. But when the market gets spooked, investors often retreat from altcoins, sometimes even from Bitcoin, and move into stablecoins to preserve capital until the next opportunity arises. You'll hear the term Bitcoin dominance. It refers to the percentage of Bitcoin's market cap relative to the entire crypto market. When dominance rises, it usually indicates that altcoins are underperforming. When it falls, altcoins may be gaining traction. Understanding this rhythm can help you navigate the tides instead of getting swept away. But here's the twist, contrarians. The game's changing. A lot of the old rules, they might not apply the same way anymore. We've now got spot Bitcoin ETFs. Yep, finally approved in 2024, which means big money from institutions is pouring in. Countries like El Salvador and the Central African Republic have gone full send, making Bitcoin legal tender. And even the finance giants like BlackRock are launching Bitcoin products across the globe. Just a few years ago, this stuff would have sounded like science fiction. So, will the classic Bitcoin, then altcoins, then stablecoins cycle still hold up? Maybe, maybe not. What we do know is that the landscape is shifting fast, and the smartest move you can make is staying curious, flexible, and ready to adapt. So, contrarians, now you know the terrain. Bitcoin is the cornerstone, altcoins are the moonshots, and stablecoins are your lifeline. Each plays a different role, requires a different mindset, and brings something unique to the table. The real skill? knowing how to mix and match these assets to build a strategy that fits your goals, your risk tolerance, and your vibe. And in the next video, we're going to break that down. How to build your own crypto portfolio strategy using these 3 zones. Because holding Bitcoin, aping into altcoins, or chilling in stablecoins means nothing without a game plan. So don't go anywhere, contrarians. We're just getting started. All right, contrarians, let's bring it all home. So far, we've taken a tour through the 3 zones of crypto: Bitcoin, altcoins, and stablecoins. Bitcoin, that's the OG, a digital asset now seen more like gold than cash. People hold on to it, ride the waves, and believe in its long-term value. Then we've got altcoins, the experimental frontier. Some are massive ecosystems like Ethereum, others are scrappy startups trying to change the world. They're exciting, but also risky, so you've got to do your homework. And finally, stablecoins, your digital dollars. They're not here to make you rich, but they help you stay steady, manage risk, and move value across the crypto world without worrying about wild price swings. Each type plays a different role. Bitcoin and altcoins fluctuate hard, especially altcoins. Stablecoins, they're built to stay put. And depending on your goals, whether you're stacking, speculating, or just staying safe, each has a place in your crypto strategy. Now this video, just the beginning. Crypto is a deep rabbit hole. You've got smart contracts, wallets, DeFi, NFTs, blockchains. It's a whole new financial universe. If this clicked with you, keep going. Look into how wallets work, hot wallets, cold wallets, and how to store your assets safely. Read up on the tech, and whatever you do your own research. Never invest just because someone online said it was the next moonshot. Not even me. If you're ready to take your first steps, try opening an account on a reputable exchange and maybe buy a small amount of Bitcoin, not to chase profits, just to learn by doing. You can explore sites like CoinMarketCap to study the top coins, or hop into a testnet or demo trading platform. Some exchanges even offer free crypto rewards just for learning. Pretty sweet way to get started. And remember, crypto can be risky. Prices go up and down, sometimes violently. Only invest what you can afford to lose. It's totally okay to start small, test things out, and learn as you go. Want to level up faster? Join the community. Places like Reddit's HR cryptocurrency or Bitcoin Talk can be super helpful. Just be cautious. Scams exist, and if someone promises guaranteed profits, that's your cue to run. Big picture, crypto is redefining finance and tech, and by learning about it, you're already ahead of the curve. So enjoy the ride, stay curious, stay cautious, and keep learning. If this video helped you make sense of the crypto jungle, drop a like, hit subscribe, turn on those notifications, and share this with your fellow contrarians. We've got more crypto knowledge coming your way, and trust me, you won't want to miss what's next. See you in the next one.